So this first one is the one that's been the most seasoned. Levi and I bought this deal, September 30th of 2024. Some of our investors may even be here, which is really cool to see where it was to where it is now. But we bought this property from the original builder who built it in 1998. So just like Levi was saying, we like to buy from long-term owners. We bought this deal for $6.8 million. And the reason we knew this deal was such a great opportunity to give kind of a backstory on it is, like Levi said, we've known each other for 5-6 years now. We took a run at a deal, 101 units about 3 years ago that ended up selling for $300,000 a unit. So when this one came across the email, we knew that it was a deal right away for 54 units built in 98 at 125 a unit was
from the original developer.
Yeah.
98
was a no-brainer. And so to make a really long story short, we were the first ones to offer on it. We were the first ones to tour it. We knew how great of a deal it was, so we put $50,000 non-refundable earnest money. And when I say non-refundable, I mean like released to the seller, which is even more risky than just non-refundable because it's just gone. And it's kind of funny because the seller actually flew to Africa like the day that he listed this. And we were talking to him late one Sunday night. He verbally said, yes, I will take Joe and Levi's offer. We'll send the documents Monday. Monday came around and we never heard back from our broker, Adam Hertz, who may be on here as well. And we called him and we're expecting the worst, and the worst did happen. A local buyer who has a local presence, who the seller knew, came in and offered $210,000 higher. And they asked if we want to increase our offer, $215,000. And Levi and I talked for like 2 seconds, and we said, you know what? We want the seller to keep his word. That's how we were raised on the ranch. And the seller was actually selling this property to buy a ranch. And he came back and said, you know what, I like these guys' attitude. And he ultimately decided to sell to us, even though he could have made $210,000 higher. And at the end of the day, we executed and did everything that we said that we would be able to do. So when we purchased it, of the 54 units, about 90% of those units were average of $783 rent. We went and did a blanket increase of $385, and we were expecting a 60% vacancy, or like for 60% of the tenants to leave. And we actually had a 60% retention, which was really cool because we only had to renovate. It was like 20 units at that time. So one of the biggest things that we learned on this property is when you can get that many units to vacate and they all leave at about the same time, which was December 1st, we were able to create economies of scales in our construction costs. In Missoula, labor is a lot more expensive, and it would have cost us about $20,000 a unit. We ended up paying about $13,000 a unit, bringing in outside labor from Salt Lake. So we brought in cabinets and flooring and paint. So that really helped us be very productive on this deal, and you can see that across the board we've dang near doubled the rent. So
because we did 2 more renewals after that first initial one. So we had a broker opinion of value done by Northmark, a credible broker. These are the guys out of Salt Lake. They're probably one of the highest, if not the highest, transaction volume brokerage. But yeah, they gave us kind of a range of value, and this didn't take into account the land value. So there's some potential opportunity to expand on where the storage units and there's a duplex is, where we're likely gonna take those out, demo those out, and expand more, a 32-plex. But yeah, this just gives you an idea of the value. We bought it for 6.8. Just 14 months ago, September of 2024, we put about $450,000 in renovations into it. We increased the average rents by about $550 per unit, averaged across all 54 units. And now it's valued at around $12 million. So we're in the middle of working on a refinance We couldn't get anyone quite to the price. We had some offers, 10.5.
Yeah.
Handful different offers at different ranges, and it's just not a great time to sell. And we feel like we're leaving a lot of meat on the bone, or value left in the deal with the expansion opportunity and being able to push rents on the other units that haven't been renovated.
So like Levi was saying, this deal is very, it fits like our buy box very well, because we want to make sure we have multiple exit strategies, so we can sell, we can refinance and keep running it, or we can like refinance and build. So we're going through a bunch of different lenders right now to see what one's gonna fit the best. So we want to kind of open it up to everybody and do a kind of a short interim Q&A. The question we kind of want to pose to everybody here is, if you were us, or if you were an investor, we bought it for $6.8 million, put about $420,000 into it. Would you sell it at $10.5 million and get investors?
Do we explain? We can explain the structure.
When we raised the capital for this, we did a full pref equity where investors get like a weighted average of 15% return. So it's just like a 15% preferred return. So investors would get, a total return of capital and a return on capital, whether we sold it or we did a refinance. And then they would just be out of the deal. And you guys are welcome to ask more questions, but we want to just get some engagement. Would you sell it at 10.5? Take the money now after 14, 15 months being in it? Would you refinance it and keep renovating units? Or would you refinance it and then build the 32 units to make 50 or 86 units.
Secondly is, usually we structure our deals where there's like a 6 to 10% preferred return, and then a split, whether that's like 50-50 or 80-20. It kind of varies depending on the deal. But on this deal that we did, that we're talking about now, we asked our investors if they would rather be in a lower risk position where they get paid back first. They're just in second position behind the lender. What, if anyone has any kind of preference in today's market, would you prefer second position to the lender, lower risk for like a mid-teens return, or are most people wanting more like higher projected returns, but you're also higher risk, like as a common equity position?
Hey, what kind of interest rates are you looking at to do that refi? Or
yeah, we have one bank quote from San Francisco Credit Union. It's at like a 2.2 spread over the 5-year treasury. So it's right around 6% interest rate, 30-year amortization. We could pay off about at least 3/4 of the money back to investors. And then the other quarter of it, they would continue getting their 15% on that money, and actually a lot more. We'd probably just keep paying them off even more, because at that point we're going to have $150,000 plus of cash flow on the deal. So if we only have another $500,000 of unreturned capital, we could pay that off within 3 years maximum. But yeah, then Fannie Freddie debt, that's about like a 160 to 170 spread, meaning 1.6 to 1.7 spread over the index rate, the treasury. Whether we do a 5-year fix, 7-year fix, those rates are in the mid 5s.
So we have a 7.5 right now. Our current rate is 7.5. And we have like just under 12 months of interest only left.
What about if you build that, how soon will you have it occupied with the surrounding buildings around that? Do you think you'll be able to fill it pretty soon after you finish building it?
The one thing I'd say on that, Shane, is so we're doing all 1-bedrooms on these 32 units, and we know the market really, really well. And Missoula is kind of liberal. They're not allowing very many new developments come online. It takes like 18 plus months for like a new deal to go through planning and zoning. So where this deal would be on the existing, we'd actually be able to get it built really quickly. And we're really hoping to work with the biggest developer in Missoula. He's doing 24 units that he's doing with Adam? 22 units. They broke ground in September and they're already dried in. And so they're been really quick. So if we were to work with them, we feel like we could, probably have a property ready to go in 12 months to where we could start filling it up. And there's not a ton. There's a couple really good comps in the area, but we feel like we'd be able to lease it up really quickly and be competitive with other market rate properties that are comparable to ours.
I've got a question for you, gentlemen. Why did you decide to do one bedrooms, all one bedrooms, instead of a mix of ones and twos?
Yeah, we already have mainly 2 bedrooms at the property. There's 24 2 beds, 16 1 beds, 14 studios. So based on demand, there's a lot of demand for 1 bedrooms. 1 reason. 2, we have less 1 beds than 2 beds already at the property. And then 3, our architect just kind of said it would fit the best. You can get the most units here by doing that design. So we've been working with a local architect and engineer firm, Morgan Hoffman, and they've already had preliminary talks with the city. And as Joe mentioned, like since this is kind of grandfathered in, we meet the park ratio requirement. We already have enough existing parking of 113 stalls, so we can do shared parking. We already own the land. The utilities are right there, so we can really build this pretty cost effective at like $150,000 a unit, and it should be worth about $225 a unit with the $1,300 projected rents, which are pretty conservative. So I think we're leaning towards doing the expansion, but trying to figure out whether we pay off investors and bring in new investors, or whether we let investors stay. I guess we just kind of open it up to the current investors and see if they want to stay in, or if they'd rather get paid off and do a new business plan.
Well, and the other thing I'll mention, Dusty, is we know our tenants too. And of the 54 units that we have 70 tenants and there's only 12 kids. And so our tenant base is largely white males that are, do their blue collar jobs.
I do the survey first and figure out who's in favor of staying in it or who wants to pull out. Once you have that, you'd have a pretty good base on whether to move forward.
Yeah.
The loss position, and just some thoughts. I don't have a preference. I do like evaluating and partner with you guys as we look at what's the best answer. I think this project is very similar of what's the survey if we have a locked and loaded group of investors that's willing to move forward and go with, a bit more risk on a build, there always is. But if the fundamentals are still there to manage that. But on the loss position, I think one of the questions that was asked, just some thoughts on the group. On the loss position, the only reason I do like a GP sitting in a first loss position or some in a first loss position are the ones that have the most control on whether or not you incur losses, right? So if I sit at a first loss position as a strictly passive, I am certainly placing a lot of reliance on someone else to monitor that, right? And so you have a compensation there. But I do like linking those first loss positions. It should have a higher rate, but also I think it's appropriate, like from your seats in a GP standpoint where you're carrying some equity in, putting some in, certainly the most incentive and the most ability to influence the outcome of whether or not you drive losses, whether that be in the purchase, the management, or the execution of a build. Just a few thoughts there. I don't think it has to be the end all be all, but that's one of the big advantages I've seen as having those closest to the deal, both on purchase and management, being also the ones in first loss, but also have a bit more top end as you get into the backside on what you would carry equity and things. So just a couple thoughts there, but this is a fun one. This is a good project. Walked through it, over the summer, and it looks good.